Well, good afternoon, everyone. Thanks very much for joining us. My name is Mark. I am Head of Risk for APM Capital. I'm very pleased to be introducing this a series of webinars that we're doing with Brannigan Barrett, and also in association with our event partner, the CME Group, the largest and most diversified derivatives exchange in the world. Just a little bit about APM Capital for those of you who aren't aware. We're a regulated broker in Abu Dhabi, and we offer CFDs and FX and also futures trading to our clients. We access global derivatives exchanges, but also do a lot of work with the CME, and we're very happy to have with us Brannigan Barrett. He's the founder of Habitus Capital, which is a boutique investment firm specializing in futures trading. He's got over a decade of experience in professional futures trading, and he's also co-founded a company called Tradelo Trading in 2021, which is dedicated to developing innovative trading tools for retail traders. Brannigan's got a lot of content on YouTube, a lot of educational content on YouTube, which has enriched the trading community, and we're very happy to have him with us explain about futures trading, day trading, and trading strategies. This is one of 3 webinars which we'll be having on the second Thursday of each month going forward. We'd love to see you for each of those, and I won't take up any more of his time because it'd be worth more than mine. So thanks very much, Brannigan. Please, over to you.
Thank you very much for the introduction, and welcome to everyone, and hopefully you have a good session today. Today, what we're going to cover is we're going to start off and talk a little bit about some key trading principles. We're then going to talk about managing risk. Very, very important, particularly with trading futures. So we're going to spend some time there. I'll give you a little bit of a futures risk strategy that you can adopt immediately. We'll then talk about some key market narratives that the market's currently pricing, as well as some opportunities off of the back of that, covering predominantly gold and the S&P 500. And then we'll move to risk event trading. Obviously, tomorrow is the key non-farm payrolls. So I'll explain to you how professional traders set up for that, what we look for, what the outlier opportunities are, and how you can potentially profit from that. Okay, now let's get into it. Like I said, what I'll typically do for all 3 parts is I'll cover some of the more liquid markets, including the S&P 500, gold, crude oil, and then I will also sometimes reference Bitcoin. Okay, yes, it's a futures product. The CME has now also got the micro Bitcoin, and it is something that more traders are looking to adopt. So we will potentially reference that over the coming series. Now, we're going to start today with a very nice quote because it's a handy way to kind of set and frame the series, which is that one great trade does not make a year. 10 to 20 trades or 10 to 20 good trades make a record year. And that's very, very important because consistency is the key to success in trading. It's not about hitting home runs. It's about consistently applying yourself. You have to work at your game constantly, and then eventually what will happen? The markets will deliver some easy hits, okay? Now, if you do this 10 to 20 times a year, that's when you get those record years. It's that cumulative effect of making really good trading decisions consistently that will lead you to long-term profitability. Now, sustainable success in trading is not about luck. Okay, there's too much social media referencing this idea of getting lucky. It's not about luck, and it's not about hitting the jackpot. Rather, it's about cultivating skill, cultivating discipline, being consistent in the pursuit of a series of good trades over time. Now, one final note on luck, and I think it's very important to discuss this concept of luck, and it's a good way to start today, is that if you apply yourself consistently, that's when luck follows as the byproduct. Now, what I like to do often, obviously I don't know you as an audience, but what I like to do is I want to relate to you. I want you to know you're no different to me. Okay? I'm a futures trader just like most of you. And I want to share a little story with you because it's a nice way to get sort of the flow going for today's session. Now, it was 2014. And I was on an incredible streak. It was the first time I actually was on a really, really good run as a trader. It was sort of year 2.5 of my trading career. And literally, I couldn't do anything wrong. I was on an I was on a very positive streak of around 12 green days in a row. And on this particular day, my timing was off. I got a little bit of a call from the risk manager saying, look, do you maybe want to stop? You've hit that daily stop of $10,000. Let's just take a step back. Okay. So I decided I'm going to call it a day. I was a bit emotional. I went out to get something to eat. And then when I sat at lunch, I distinctly remember a feeling of something's not right. I didn't check my order book. Okay, so I didn't check if I'd cleared all my orders, all my limit orders sitting in the market. So I called the office back and I said to the risk manager, look, can you just check my order book, please? I'm a little bit concerned I left something there. And then there was a brief pause, and he came back, said, look, you're long 30 lots in the German bonds. And I said to him, just cover the trade, just cover it. He then said it's done. And I said to him, can you confirm my P&L? And he said to me, you're up $2,500. Okay. The point is that it's not about getting lucky. Luck follows as a byproduct. If you consistently apply yourself and you keep working at your game, at some point luck will follow as the byproduct. Now, what we're going to deal with over the next 3 series is I want to cover these 7 questions. Today, we'll obviously deal with question 1 and 2, which is what are the key benefits of trading futures? And what does a typical equity curve look like for most traders? Okay, that's where we want to go today. In the other series, part 2 and 3, we'll cover some of the other questions. But let's start off with question 1, which is what are the key benefits of trading futures? Now, for one, obviously leverage. Okay, futures is a leverage product, but it is very scalable. Now, traders ultimately can have 100% returns a year. Okay, and you can double an account. It's very, very possible because of the definition of what leverage gives you. Okay, it's what allows us to make $100,000 in a single trade with only a $50,000 account. Right, leverage ultimately allows us to take advantage of really important risk events. And we'll talk about one of those risk events with regards to non-farm payrolls a little bit later on. Now, whilst these events occur infrequently, in other words, outlier events, risk events, they do occur quite infrequently, roughly around 5 times a year. It's very, very important to understand that having that leverage at our disposal is what enables us to make those really good days. But it's not a case of, oh, we take random risks. They are very calculated risks where the probability and the odds are very much stacked in our favor. Okay. Another reason and the benefits of futures is margin trading. Okay. Obviously, with futures, we don't have to put down the full notional value. If you traded a stock like Nvidia, for example, that's at $900 and you bought 100 shares, you're going to need about $90,000 of capital just to take that trade. Okay, so with futures, obviously, it's very much a margined product. And yes, whilst I am referencing all the good stuff about futures, obviously the drawback is when it's margined, it means that you obviously have got the downside as well. Okay, but only having to post a certain amount of capital to have exposure is very important, particularly from a futures trading perspective. Right, liquidity. Futures markets are very, very liquid, okay, especially for the popular contracts like the S&P 500 or gold. High liquidity means that we can enter and exit positions with very large position sizes and avoid partial falls. Okay, and this really matters. We'll talk a little bit about risk in a minute where, everything matters. So if I have to execute a 20 lot in gold, for example, if I had to do that over 3, 4, 5 prices, I'm paying a lot away in slippage. Okay, so because the futures are so deep in terms of liquidity, I can put relatively good positions in the market without even causing any kind of slippage or partial fall. Multiple asset classes. Okay, and this is very, very important. With futures, you can trade all asset classes in essence. Okay, you can execute foreign exchange, you can trade bonds, you can trade interest rates, equity indices, commodities, crypto. You can trade it all via a single centralized exchange. Okay, and it's a very heavily regulated exchange. And again, this really does matter because if you look at the past, some of the blow-ups that have occurred, typically that comes when there's a mismatch of where funds are and who's regulating. So having a product that's very heavily regulated is very important for us as traders. Okay, now coming back to the asset class or the multiple asset classes, this gives us diversification. Okay, very, very importantly, if you look at the last 9 months, trading currencies has been really difficult. Okay, the ranges have narrowed, the volatility's disappeared, which means that in essence, the opportunity scope in FX has disappeared. Now, if you were, for example, solely trading Forex or only trading FX, right, you would have had a really difficult past 9 months. With futures, like I said, because you can trade multiple asset classes all via futures, when the FX goes quiet, you move over to the bonds. When the equities goes quiet, you can perhaps trade the interest rates. Okay. Then finally, tech and education. All right, very, very important. If you look at a lot of the new technology and education that's available nowadays, it's all being geared towards futures trading. Why? Because that's where the demand is. Okay, more and more traders are adopting futures because of the benefits I've just mentioned, and a lot more firms are now investing in the technologies and the educations, in particular around futures trading. Okay, now that's the key benefits of futures trading. Now, the second part I wanted to discuss with you, the second topic I want to discuss with you is what we call, the typical equity curve or equity curve dynamics. Now, this is very, very important, particularly for when I say younger traders, I don't mean age younger. I mean traders in their first 3, 4, 5 years. It's sort of this understanding of what will my pathway look like? What will my journey look like in the initial years? And I find so often traders look at this and they go, wow, I never really thought of trading in this way. Okay, most traders think of trading, they come into it on day one and they assume profitability. That's the natural tendency. I think that was my tendency when I started. I believed I'd make money in the first month, effectively. It doesn't work that way. I've mentored so many traders since 2013, and I've yet to see a trader make money in their first year of trading. Okay, and there's a very good reason for this, and that's what this graphic is all about. So what are we looking at here? Well, reality is in year one, if we kind of look at this first block, and I'm just going to annotate this for you. If we kind of look at this first section here, we call this year one. Okay, it's that point where, in essence, we're making a lot of bad decisions and we're not making very many good decisions. Okay, you effectively in your first year have got insufficient experience. That's a fact. It doesn't matter how smart you are, what age you are, you've got insufficient experience with regards to trading futures. Okay, now rather than think about trading as win rates and strategies and all that, I want you to visualize trading as your good decisions versus your bad decisions. Okay, now at the start of your trading journey, you're going to make a lot of mistakes. It goes without saying, and this is normal. It's typical. This is unfortunately the price you have to pay for experience. Okay, if you use those experience now in a constructive and an iterative way, what happens is you start to develop that thing called edge, that thing that everyone references as though it's like a light switch. It's not. It comes from experience. Now, early in my career, I constantly got caught out fading trend days. It was something that frustrated me immensely for over a year. What I eventually did, it took me about 14 months to eventually do this, but I added what we call a relative cumulative volume indicator. It sounds fancy, but it's not. All it's doing is saying, at this point in time, on this day, this is what the typical amount of volume would be in this market. That's what it does. And what I noticed with trend days is that when we have a trend day, the relative cumulative volume is typically a lot higher than the average. Okay, call it 1.25 times higher or above. And what I realized was if I can simply just not fade a market that's showing well above average relative volume, I can avoid fading trend days. And guess what? I implemented it and I've never faded a trend day since. Okay, now it's not to say that all of a sudden now I'm going with trend days. It's not to say that all of a sudden I'm making money out of trend days. But what I'm not doing is I'm not giving away money, what we call controllable losses. I'm not throwing money away unnecessarily because I've now gained what we call an additional edge. Okay, now very, very important. Coming back to this idea of good decisions versus bad decisions. Right? What happens is that over time, if we survive, we move into block number 2. Now, what typically happens is traders go one of two directions. Some traders go the smart way. And the smart way is where they manage their risk. The smart way is they don't throw away needless money. They don't take, big swings of the bat, try and chase back losses. They simply accept that trading is something you have to develop through experience and time. In other words, they accept that they come in each day, they learn a little bit each day, and over time they get experience, they iterate, they grow, they learn, they develop edge through time. That's the smart way of doing things. The wrong way of doing things is where we come in and we say, well, look, I have to make money. That's what a trader's supposed to do. And they chase, and they over risk, and they throw money away, and they bin an account, and then they put more money in, and then they bin an account, and they never actually understand that trading is not about necessarily having big winners, but it's more about developing the experience, the knowledge, the skill set, the edge, and then implementing that edge in such a way that you can actually start to become profitable. Okay, so there's two pathways, and again, very often most traders, hence why the failure rate's quite high, most traders go this direction because they chase back and they assume that trading is about making money. It's not. It's about developing skill. Money is the byproduct of skill. What happens though, however, the traders that follow the smart pathway, note there's always a drawdown. Okay, in the first year, you're always going to have a drawdown. Why? Well, because the reality is there's a cost to trading, whether that's paying for your subscriptions, whether that's paying for your, your brokerage, whether that's paying for your charting platforms. There is a cost to trading. Okay. In the second year, however, what happens is our good decisions start to match our bad decisions. In other words, because we're making less bad decisions, by definition, we're making more good decisions. As a result, we start to see profitability in the account, and that drawdown is erased. In other words, we get back to that break-even point. Now, typically, this happens around month 18 for most traders. If you get to that point, if you can find break even, the next part's the exciting part. That's the exponential part. And again, this is nothing different. It's not like you're taking bigger winners. You're not suddenly looking for 10-to-1 risk rewards. None of that changes. The process of a professional trader never changes. What changes is that your edge, which is developing more and more good decisions as a result of eliminating bad decisions, starts to increase. Okay. And all that happens as a result of that is if you look at your distribution curve of profitable days, you start making more profitable days, you have less down days, and as a result, that account balance starts to increase. Okay, now what we'll talk about in the next slide is risk management, because what happens when our account balance starts to increase, our position sizing increases as a direct result of that account balance. Okay, and this is crucial. This is what makes risk management so powerful. As our account balance grows and we make more money because we're developing an edge, our position sizes increase as well. And as those position sizes increase and we maintain that edge and that consistency, our account starts to go exponential. That's the key to trading. At no point am I suddenly looking for 1-to-1 winners here and 3-to-1 winners here. It's not about a risk reward. It's not about win rate. It's about developing a protocol where my good decisions outstrip my bad decisions, and I constantly learn through experience. That is ultimately the typical equity curve that professional traders will follow. Now, let's talk about risk management 101. Today, what I'm going to show you is what we call the equal weighted risk system. Now, the reason I always start with this is because most traders typically don't even have an approach to managing risk. Now, the root cause of 90% of the mistakes you make will come from bad risk management in some shape or form. And this is why it's got to be a priority for you, regardless if you're in year 1 of your career or year 10 of your career. In today's session, I'm going to teach you one risk strategy that you can adopt immediately. It's very simple, very straightforward. You can look and go, it can't be that straightforward. But I will tell you, if you go look at some of the greats, the Carl Icahns of the world, you know, the big billion-dollar hedge funds, you will notice that some of them adopt a strategy that's almost identical to this. They just do it in a slightly different way. Okay, so it's not, managing risk is not about complexity. It's not about math. It's not about, having some modeling approach to risk. It's not about that. It's all about consistency. Okay, now there are a number of ways you can manage risk. You can adopt any number of different strategies. The approach is not as important as applying it consistency. Okay, the key is being simple in the approach so that you can consistently apply that strategy. If you can do that, you've got a highly, highly effective risk strategy. Okay, now let's have a look at the equal risk strategy. Well, actually, before that, why do we need to adopt the risk strategy? It's going to sound a little bit obvious, right? And we're all going to go, yeah, of course I know I need to adopt a risk strategy. Yet 95% of traders don't adopt a risk strategy. They don't have any approach to developing what position size they should use. And with futures, because it's leveraged, by definition, we have to pay very, very close attention to the position size we're using because, like I said, yes, the upside's magnified. Yes, the potential to profit is magnified, but so is the downside. And that's why, particularly in futures trading, we've got to make sure we take care of risk management first. Now, there are 5 reasons why you have to ultimately take care of your risk management. One is survival, right? Like I showed you on that equity curve, ultimately you've got to survive that first 18 months until you've gained that sufficient experience and developed that edge. If you don't have any capital, you don't have capacity to trade and learn. That's just a fact. Risk management will ensure that you get beyond those first 18 months. It'll make sure you survive. It'll make sure you don't have that unnecessary drawdown. Then risk management ensures that we're not biased. Okay, when you have a predetermined strategy that ultimately tells you buy 2 lots, buy 5 lots, buy 6 lots, there is no bias involved there. It's predetermined and it's systematic. In other words, it's done automatically for us. So with a risk strategy, every position is predetermined and we cannot be subject to our biases. With a risk strategy that is predetermined, we're 100% consistent in our application. And like I said, the key to risk management is to just apply it in the consistent way every single time. That's what makes it powerful, not the math. Finally, or second last, blow-up days are a huge setback. Okay, when you have that deep drawdown, you will recognize that feeling of fearfulness, that feeling of, I don't trust my system anymore, that feeling of, how am I going to get this loss back? So why take that loss in the first place? Okay, it simply just sets us back in terms of progression significantly. So it's not worth it. We have to avoid those deep drawdowns because we need to protect our progression and make sure we don't, suffer the consequences that come as a result of not managing risk. Okay, and then finally, if you're scared to lose money, and this is for almost all traders, and the younger you are in terms of your career, the more afraid you are of losing money. The reality is if you're emotional when it comes to managing risk, it's because you're not managing risk properly in the first place. Okay, so with a predetermined risk strategy in place, you can accept risk before you assume the risk. In other words, before you click that button on your mouse, before you take that long position in the S&P 500 breakout, you already know what the risk is that you're going to put in the market. You know what that position size is. It's pre-calculated, predetermined, but pre-thought about. You've thought about it and accepted the loss even before you've put the trade in the market. Okay, what that helps you do is eliminate emotion completely from the equation. Now, like I said to you, risk strategy, you can adopt this immediately. Get an Excel document up, and it's a couple of cells, and you will be able to determine your position size automatically for the rest of your trading career. Okay, and remember what I said, it's not about powerful math. It's simply about consistently applying it. Okay, so what you're going to do, step number one, you need to work out your average number of trades per day. Okay, so you have to go and work out how many trades do I typically take a day. If you're a bit more of a swing trader and you take one trade a day, nice and easy. If you're someone that trades perhaps only a couple of times a week, again, nice and easy. If you're someone that's more active, you need to keep track of what is your average number of trades per day. Okay, you should be able to get that from your system quite easily. Then, what is your daily stop? Okay, you should all have a daily stop. You should all know what is that hypothetical dollar amount, what is that percentage of my trading account I'm willing to lose on each day. Once you have that, you're simply going to take that daily stop, 1,000, and you're going to divide it by the 4, okay, which equals $250. And what that represents ultimately is that we can risk $250 for every trade we take on the day. Very simple. You're going to go, it can't be that simple, but the reality is it is that simple. Right, the key to it is applying it consistently with every single trade we take. Now, one thing I like to do, and one thing I suggest traders typically do, because by definition, we all overtrade because we all get excited and like to get involved when the markets become a bit more volatile. I always like to add one day to the average number of trades that I take. Okay, why? Because typically what that means is I'm being a little bit more conservative, right? So rather than 1,000 divided by 4, you can simply say 1,000 divided by 4 plus 1 equals $200 per trade. Okay, so if you want to add that little bit of a conservative approach to managing a risk, that's one way you can do it. All right, then it's very simple. To work out your position size, trading the full contract S&P 500, we take the $250, we divide it by where we're placing our stop on the trade, multiplied by the tick value, very straightforward, and that tells us straight away you can use on this trade you're going to execute where you have a 10-handle stop in the S&P, you can use 5 micros. Okay, it's as simple as that. There's no thought required. Yeah, all I simply input into it is how wide is my stop going to be, and everything is pre-calculated. Right? Never again do you have to guess, how much you should risk on a trade. Never again do you have to worry about having a deep drawdown. It's not possible to have a deep drawdown unless you don't follow the predetermined risk approach. Okay, and that's the key to risk management, is just to have some methodology. It's not about powerful methodologies. It's not about probabilistic, modeling. It's not about that. It's about just being consistent in the approach, because that'll ensure you're always risking an amount that is ultimately based on your account size and your daily stop. Okay, now there's a number of ways we can do dynamic adjustments. Dynamic adjustment, again, is just a fancy way to say improve this approach. One approach, like I said, is you can add a +1 on the average trades. Okay, that's one way you can make it a little bit more dynamic, particularly if you're over trading. If volatility is high, okay, we'll talk a little bit about VIX in a couple of slides. If volatility is a little bit higher, again, you can add another 1 to the average trades. Why? Because by definition, more volatility means more tradable opportunities, which means your average number of trades will go up. All right. Our daily stop size is a percentage of the count. Okay, this is something that we can play around. Ultimately, what's very, very important is when you choose a daily stop size, stick with it. Don't keep chopping and changing it. We'll talk a lot about how to choose that daily stop size in the second part of the series, but you can ultimately determine your daily stop size, and that makes the model quite dynamic. Okay, so that's a very, very simple strategy. You can implement it immediately and you can start managing your risk consistently. Now, just very briefly, some of the advantages and disadvantages. The key to risk, like I said, it's not about the model you adopt, it's more about why you're adopting it. Okay, now what you must notice with this strategy is it has got downside, but it's also got upside. Very simply, it's a simple strategy. It's very basic math calculations. You can all agree there's nothing complex about it. It's a very consistent methodology. It's the same thing over and over again. There's no bias, there's no subjectiveness to it, there's no probabilities involved. It's simply just X divided by Y. It's as straightforward as that. And it's very, very good to learn effective risk management. Okay, so if you're new in your career, if you're in that first 2-3 years, this is a very powerful strategy to adopt. However, there are disadvantages. Okay, one, we don't maximize on profit potential. All right, we're doing nothing with regards to probabilities. You know, if we have a very high probability outcome and we're risking an equal amount, the reality is we're leaving chips on the table. All right, we do lose the power within effective leveraging. Why? Because ultimately our position size is always going to be more or less the same. It does also mean slower account progression, not no account progression, but slower account progression. And it does require a high tick win rate to get that account moving forward. And then ultimately, what is the right amount of average daily trades? Okay, you would need to manually calculate that within your Excel sheet. But again, whilst that is ultimately a downside, it's something that you can automate for yourselves. Okay, so that's some of the downside and the upside. Now let's move on and let's talk about some fundamentals. Okay, one question I get asked a lot. It's something that always comes up when I mentor traders or I do a webinar. They always say to me, you know, is there a book or a course that they could buy or take that they could learn about fundamental analysis? And the short answer is no. You don't learn about fundamental analysis through books and you know through a course program. Where you learn about fundamental analysis is to practically apply it. It's ultimately fundamental analysis is nothing more than observing relationships. It's observing market context. It's observing policy frameworks. What are central banks doing? Now, if you want to learn fundamental analysis, if you want to understand how it impacts markets and price ultimately, the best way to do it is like this. Okay, whenever you read a Bloomberg article or a Reuters article or an Economist article, or you listen to Jerome Powell, or you go and see the ECB's policy decisions, go and observe what you've just read and interpreted against a chart. Okay, so you read what Powell said. Powell said that they are not going to begin the process of cutting rates until they have more evidence inflation is returning to target. Okay, go and see how the market reacts to that. Because ultimately, you're going to learn through reading how the market interprets things and reacts. You do this for a long enough period of time, what'll happen is you develop your own playbook of fundamental plays. All right. And that's the key to learning macro fundamental analysis. It's about taking what the market tells you, learning from it, and then applying it going forward. Now, it's very important to stress. You don't need to know anything about fundamentals to be successful, and you don't need to know anything about technicals to be successful. What you need is your own framework that you can consistently apply. Now, I mentioned edge a little bit early on, and I told you it's ultimately just the culmination of experience over time. So what you need to do is you need to find what works for you and keep it. You need to get rid of the things that don't work for you. And ultimately, that's how you build your own framework. And sometimes it's going to be a mix between technicals and fundamentals. Sometimes it's going to lean a little bit more on the technical side and sometimes on the fundamental side. It doesn't matter how you develop your framework. What matters is you consistently apply your framework over time. Okay, don't worry about being wrong and right. There is no wrong and right in trading because the market ultimately dictates what's right and wrong. Okay, and also just as a note, we spoke about risk management, and this is why risk management is so crucial. Right, we can be wrong, but the important thing is the risk management will safeguard us and it'll ensure that we learn cheaply when we are wrong. Okay, that's why risk management is so key for us, is that it enables us to learn over time, to develop that edge, to develop our own framework. Now, at the start of this year, coming into this year, 2024, what were the key market themes? Well, if you rewind your thinking back at the start of this year, the Fed was going to cut 6 times. That's what the market expected. We obviously got the Powell pivot in December. Everyone was talking about 6 rate cuts. The market was priced for 6 rate cuts. And as a result, we had equity markets and gold tapping on record highs. Okay, that was the narrative coming into this year, as well as the US was going to achieve the coveted soft landing. Now, we've only ever had one soft landing in history. That was in 95. And I do encourage you perhaps to go and have a look at 1995 as something, as a fundamental sort of case study you can do to understand what a soft landing looks like and what it ultimately represents for markets. But the reality is that ultimately that soft landing was grounded on this idea that goods and services, we would continue to see that disinflation that all central banks, not just the Fed, all central banks have been talking about. So this was the key. This is what we were faced with at the start of this year, which is 6 rate cuts, a soft landing, and would continue to see disinflation. And as a result, 2% targets would come into view for most central banks. Now, we're now on the 4th of April, and fast forward, what have we got? We've got inflation that's bumpy, but ultimately the Fed has told us they want an insurance cut. They want to cut in June, and if data stays like it is right now, that will be sufficient. And they're also willing to accept higher inflation for a little bit longer and only return to target in 2026. And we'll talk a little bit about what this means because it's significant. Okay, what we heard from Fed's pal just 2 weeks ago is really, really significant. And I'll show you a few charts about how this is evolving. But the first chart we're going to look at is ultimately the curve steepening. Okay, and this is where we can see this idea that the Fed is willing to tolerate higher inflation for longer. And we're starting to see that now with a steepening taking place in the US curve. And the key question I want you to understand today is the market sending a signal that the Fed perhaps is making a policy error? Okay, we'll talk a lot about that in the coming slides. Then another key sort of market pricing that's happening as we speak is the commodity index rally. Okay, so we're seeing a lot of commodities break out, rally, led predominantly by the gold market. And then, like I said, finally, gold's positive correlation with yields. Okay, it's a significant development. It's something you have to be paying attention to because it means something for us. The market's telling us a story, and it is a really key risk factor for the outlook, particularly in the near term and over the coming months. Okay, so let's get into it. Let's go over 4 charts. Let's talk about these 4 concepts, these 4 sort of market pricing, and you can start to build a really good sort of fundamental understanding of what's going on as of April the 4th. Now, pretty much the start of this year, inflation came out a little bit higher than expected for the US economy. Okay, and what we saw was a higher print in Feb, a higher print in March, but Jerome Powell came out at the March meeting and he told us, look, yes, it's been higher, but we think it's seasonal. We think it's likely to disappear. And yes, inflation may be bumpy in the near term, but it doesn't change the long-term trend. And the long-term trend is what you see in essence in the orange line there. That is the Fed's core PCE, and you can see it's the 12 months, so it's a 12-month average, and you can see the trend is very firmly down. Okay, there's nothing that alarms the Fed about that. In the green, what we've got is we've got a moving average of just the last 3 months. Okay, so again, this is what the Fed looks at. They look at a 12-month, they say, well, look, right now we can see it's coming back towards that 2% target. All right. They're also looking at the 3-month, and they can say, well, look, yes, we've had a little bit of an uptick in February, in March. However, the 3-month is still pointing to an average of 2.86. However, what we have seen now from the PCE is this tick up on the month by month to around 0.3. And we can see, if you look at the 2 red lines here, ultimately, this is the range of monthly PCE that the Fed was experiencing during 14, 15, 16, 17, 18, and 19. So this is the typical range of PCE, somewhere around 0.1 and 0.2 month over month. That's a typical range of PCE that the Fed likes to see that ensures that inflation is moderating and moving towards target. Okay, so this is why the Fed is so confident that it is just a near-term seasonal issue and it's just bumpy and it's nothing to be too concerned about. Now, very important is that, 2 readings, sure, the Fed can talk that away. They can say, look, it's not a concern, and we're still going to be in the process of cutting in June. However, should we get another higher print this month? Okay, inflation typically comes out in the middle of the month. That's the headline CPI data, and the PCE that you're looking at comes out at the end of the month. But remember, CPI is ultimately a leading indicator of the PCE because a lot of the components that go into the CPI go into the PCE. Okay? But what you can see is that Powell told us just yesterday, he said, it's too soon to say whether recent inflation readings are more than just a bump. In other words, they want more data. He told us the Fed has time to let incoming data guide its policy decisions, and they're moving meeting by meeting. And he told us that the recent readings on job gains and inflation, yes, they're higher than expected, but they do not materially change the overall picture. In other words, he's downplaying that data, and that's why the market is so confident that even with the really good data, even with CPI printing higher, the Fed is reluctant to not start the cutting process as soon as June. Okay, they're pushing back despite the fact the data saying they should hold off, right? And that's where this idea of an insurance cut comes in. The Fed simply believes that they need to begin the process of cutting. They can always cut once and then wait, but what they don't want to do is cut late and then run the economy into recession. Okay, let's move on to the next chart, curve steepening, because this is where we start to see this potential idea of a policy error. Now, I'm not going to go into too much detail on this. Curve dynamics are a little bit more technical. If you're a bond trader, you'll understand exactly what I'm saying. But what I do want to show you is ultimately one part of the framework for the bonds that we saw last year and show you how that's relevant to particularly what we're about to see over the coming days and weeks. Okay, and what you'll see if you rewind back to July 23, in the green we've got the US 10-year yields, and in the orange we've got the US 2-year yields. Now what you can see is a catch-up. Okay, you can see almost, let's call it the gap. The gap between 10-year yields and 2-year yields narrowed starting in July last year. What happened? Well, that was effectively the last time the Fed cut interest rates. But as a result, we got quite a significant steepening, bear steepening in particular, led by the back end of the curve. Okay, so you can see the back end very much did most of the move. The 2-year barely moved. Okay, it stayed very much range bound. Now, this steepening effect is very, very important because ultimately what it does is it creates a bit of a tightening effect. Now, particularly when it's led by the long end, you must remember most institutions or most companies in the US lean on longer dated rates. Okay, if you think of mortgage rates, they all lean against longer dated yields, not shorter dated yields. So that's why, in essence, we got quite a correction of 10% over August, September, October from the S&P 500 last year. It was that steepening effect, that bear steepening effect, that really had implications for the markets. Okay. Then obviously we had in October, the market suddenly said, well, look, that's it. The Fed's done hiking. That's the end of the rate hike cycle. As a result, we saw, again, no real curve adjustment, a little bit of flattening, as you can see in the purple. But ultimately, the market said, that's it from the Fed. They now started pricing in the process of cutting rates. Okay, and the market really loved that. You can see the S&P took off, a significant rally in the S&P. Why? Well, because the Fed's going to begin the process of cutting rates in the near term. Okay, if you fast forward to December, like I said, there were 6 rate cuts already priced in by December. So the equities loved that. The risk markets loved that. Gold in particular loved that. Now, what I want to draw your attention to, since the FOMC meeting, what we've started to see is quite an aggressive steepener again. And where is it being led by? It's led by the back end. Okay, so we can see that 10-year yields are making a new high on yield this year. 2-year yields are very well contained. And why? Well, because the Fed's saying we're not going to avoid cutting. We're going to start that cutting in June. We still think we'll cut 3 times this year. So the market's saying, well, if they're going to cut, ultimately they're going to loosen conditions to the point that inflation perhaps stays higher for longer, and ultimately they're willing to run the economy hotter, which means term premium needs to increase as well. And that's why we're seeing longer dated bonds sell off or yield rallying. Keep a very close eye on this. Okay, if this steepener continues and we get back above 0, you can expect that S&P to move into a correction phase. Now, the next theme is the commodity rally. And again, I'm not going to spend too much time here. This is the Bloomberg index. All I want to pay attention to is if you go look at where we were pre-COVID and where we are now, we almost took out the entire rally. Okay, so that rally that came as a result of COVID, that by and large has come back. And as a result, goods inflation or goods disinflation is what central banks have really been positively talking about. They're really happy that inflation will come back to target simply because goods inflation has disappeared. However, what we've seen now over the last particularly 2-3 weeks and this year so far, WTI oil is up 15%. Okay, silver's up 14%, copper's up 5%, cocoa, okay, it's up 130% on the year. So a lot of the commodities are rallying very aggressively. Now, in particular, oil matters more than anything else. Why? Because Everyone around the world, every company, every individual is impacted by the price of oil. Okay. Now, again, we're going to lean on last year. We're going to reference last year because we saw a very significant rally from July to December, from July to October, and then a sell-off in oil. Okay, we can see that in the orange. And as a result was 10-year yields rallied to the high of the year, and then they sold off. Okay, now we've broken back above very key levels over the course of the last couple of weeks in oil, and we're looking to move back up towards that $94 a barrel. What are the implications for longer dated yields? Well, they're going to move back up higher. Why? Because it impacts inflation expectations. One final note, the ECB is forecasting oil at $75 a barrel for this year. We're currently trading $85 already. And the average, that's this purple line here. Okay, what I like to do is I like to keep an average of the year. Effectively, the average for oil so far this year is around $78 a barrel. In other words, we're $3 above the ECB's forecast, which means it's very likely the central banks, including the ECB, are going to have to raise their expectations for the impact of inflation. Okay, now, this is very important. The gold inverse relationship with yields, and it's something you pay very close attention to. You've got to get this chart up. And at the bottom here, what you've got is a correlation chart. Okay, so what we're doing is we're saying, show me the correlation between yields, which I've got in purple, and gold, which I've got in orange. Because when gold has a positive correlation with yields, in other words, when gold is rallying and yields are rallying higher, there is effectively or typically some sort of a risk event taking place. Okay, it's very unusual for there to be a positive correlation between yields and gold. So when there is, we pay attention to it and we need to be aware of it. Now, again, we lean on last year. January last year, what did we have? Well, going into January last year, the whole market was pricing in a recession. As a result, gold rallied with yields in essence. Okay, so that's the first significant reference point we have. If we move back to September, October, again, we can see that very strong positive correlation. Why did we get that? Well, what happened in September was the Fed told us that they're going to hike 2 more times in 2023. The market didn't like it. The market sent a signal and say, you're going to have a policy area there, Mr. Fed. And all of a sudden, what happened in December? The Fed pivoted. Okay, and now what we have is again a very strong positive correlation between gold and yields. Why? Well, because the Fed's just told us we don't mind higher inflation, we accept higher inflation for longer, and we're going to start cutting rates even though we haven't achieved our 2% target. So the market's telling the Fed, you are making a policy error. Okay, what does that mean for markets? Well, it means at some point the volatility is going to pick up, and at some point ultimately equities will respond to it. Okay, what I've got here for you now is the correlation between, or we've got the correlation of US yields and gold, and at the bottom I've got the S&P 500 for you. Again, every time that correlation is positive, S&P returned 6% last year to the downside, again 6% in October last year. This time will not be any different. Keep a very close eye on these equities. I'll show you a nice chart in a minute, but in essence, we should start to see a little bit of a corrective move in the S&P 500. Now, what are the key market opportunities? All good and well having this fundamental understanding, this playbook of fundamentals, but in essence, there are 3 markets to pay attention to in the near term. Gold, because it's in price discovery mode, it's massively outperforming all markets this year. The S&P 500, because it's in a very key technical shape, which I'll show you. And then the VIX crush. Okay, let's talk about these 3 ideas. That's gold. As you can see, we've broken out 2 record highs above 2070. It was a triple top for 2020, 2021, 2022, and for 2023. In other words, it was a massive resistance level. Now, once we break into these multi-year breakouts, you cannot be looking to sell that market. Gold is just not a sell. You don't sell the gold market unless the Fed was to come out this year and say, we're not going to cut rates and we're going to hike. Okay, if they did come out and say we're going to hike, gold will be in some significant trouble and will collapse a significant amount because everyone is positioned for the cutting cycle, for the Fed to run things hot, for the Fed to accept higher inflation. Okay, that's what's driving gold, and that trend is not going to slow unless the Fed pivots again towards higher rates. Okay, now one little technical indicator you can add to your gold so that you can join this rally is a 20-day moving average. It's the one time that I do encourage you to use a moving average. It's when a market's trending. Okay, why? Because the market, it's not that the line means in anything, it's just the moving average tells us that ultimately the market has had time to catch up, or at least the overbought territory has had time to diffuse itself. Okay, so it's the one time we do use a moving average, and I would encourage you to use a 20-day moving average. So again, when the gold does start to peel back, however it does it, at some point it will retest that moving average, and that's the point you want to look to establish longs in the gold market. Now, I mentioned the S&P 500. This is that trend channel. Like I said, there's a key risk in this S&P 500 that we will drop off in the coming sessions. Keep a very close eye on it. The trend channel, again, doesn't mean anything for us other than at some point there'll be an acceptance that we are in a corrective phase. Okay, now keep in mind, S&P is up 28% this year. So at some point when that corrective phase begins, like I said, we had a 6% correction twice last year as a result of that strong positive correlation. So at some point that's going to mean something.
Brannigan,
yes, Mark.
just
Yeah.
You wanted a 5-minute
Perfect.
warning?
Perfect. Thank you. Okay, now one other thing to pay attention to, what's going to be what we call a proxy market. So very, very important with regards to the S&P 500 in particular. This is what we call a rebasing chart. Okay, and I'll show you another one of these in the upcoming series. But this just shows us leadership. It shows us what's strong, what's weak, what's leading to the upside, what's leading to the downside. And as you can see, since the start of this year, there's pretty much only two equity markets that are driving all equity indices, and that's Meta, that's up 46% this year, and it's Nvidia, that's up 86% this year. Okay, everything else is roughly in line with the index. So watch watch Meta, watch Nvidia. If they start to offer, we start to see some profit taking there, the indices will peel off as a result. Okay, finally, what is this idea of a VIX a fade ultimately? Well, what keeps happening, you'll notice, is every time the VIX has spiked this year, it's been faded. Okay, and what that's led to is over the course of the entire year, you can see this purple line, we've had an average VIX around 14.5. Okay, again, another very good time to use an average is use it on the VIX. Why? Because it tells us what the VIX regime is like. In other words, what's the context of volatility within the S&P 500 right now? And as you can see, it's dead. Okay, 14.5 is not a value for the VIX that you want to be aggressively looking to sell risk markets. Okay, so what do we want to see here? Well, we want to stop seeing these spikes being faded. You stop seeing that corrective trend channel in the S&P 500 should resolve itself, and you should be capable of shorting S&P 500, NASDAQ, Russell, as the regime will change and the VIX will likely pick up. Okay, finally, let's talk a little bit about non-farm payrolls for tomorrow. How do we set up? How do we trade it? It's quite simple. We're always looking for outliers. Okay, it's not a case of we trade price, we trade technicals. We look for outliers. So what we need to understand first and foremost is what is the current stance, what's the market's pricing, and ultimately what goes hand in hand with that. Remember what I said to you. Right now, the market thinks we're going to get a perfect soft landing. Right now, the market thinks that ultimately the Fed's making a policy error. Okay, should we get tomorrow effectively an unemployment rate that's around 4 or 5%, or call it 4.1%, an outlier. Okay, the reality is that the bonds are very quickly going to price in a recession. As a result, gold is going to rally significantly because it's already in outperformance mode. So we keep an eye on that. If that unemployment rate comes out 4.1% above all expectations, okay, of 3.8%, ultimately, that's going to create a very good tradable opportunity for us where price doesn't matter as much because the market needs to reprice itself. Okay, another example, the headline expectation is for 213,000. Should that number come in below 165, that's an outlier trade opportunity. Why? Because it'll be the lowest in 12 months, and Fed's Powell told us in the March meeting that should unemployment tick up quite aggressively, or should the jobs situation change quite significantly, they won't hesitate to begin the cutting cycle. Okay, so that's what we look for. We look for the outliers. We make sure we interpret what the trend is in the data. What are those key numbers to pay attention to? And then we set up accordingly. Now, just one final thing. I'm going to skip this chart. Just in terms of key career lessons, I like to always leave you with something to think about. I try and dispel a lot of these traditional, ways of thinking that you get on social media. And these are 4 things that, for me, if I was to write up a list of, what are the 20 career lessons I would like to have learned earlier, these are them. Okay, so number 1, edge evolves over time. Right, we've spoken a lot today about, edge isn't something you, like a light switch, you turn on and off. It's something you build over time by making more good decisions and less bad decisions, right? So because it's evolving, don't get married to one single approach, right? Maybe you've heard something today during this webinar you like, add it. If it adds value, keep it. If it doesn't, get rid of it. That's the game of trading, evolve with time. Number 2, avoid rules of thumb. This idea of buy low, sell high, and the Santa Claus rally, all of that is just a waste of time. It just puts a bias in your head and it adds no value to you as a trader. Okay, it makes something that's quite complex seem simple, and that's not enough for trading, right? So get rid of rules of thumb. The all-in button in risk management, right? It's very, very important. Nothing's ever a certainty, right? This is something I've learned firsthand. You never want to be 100% certain about anything because nothing is 100% certain. Always manage risk first and foremost, right? There is no excuse for blowing up an account when you can manage risk management. Finally, if you learn to gamble with a small account, if you have bad habits with a small account, you are going to gamble a large account. Okay, so every single day you're trading, every decision you're making, always practice as you intend to play. Right? Those are the 4 key career lessons I'll leave you with for part 1 of the series, and then when we get to part 2 and 3, we can discuss some more of those key lessons.
Good stuff. Thank you so much, Brannigan. I like your emphasis there on risk management. Someone did tell me once upon a time that, yeah, good trading is good risk management, and something that I believe in. Going back to your earlier kind of explanation and description about kind of, becoming a trader and the trader mindset, would you say that it's a process-driven approach?
Very much process-driven approach. It's all about, this is how I do it now. This is what's working for me. Keep doing what's working for me. This is what's costing me money. This is the decision I made today and it didn't work. So it's always about just iterating and then take the iterative behavior and improve upon the process. And you just refine that process over time. There's too much emphasis now in trading on, I need a strategy. It's not about a strategy, and it's not about risk reward. It's not about having 3-to-1 winners. None of that matters. What matters is the process you adopt. You can be a very successful trader that takes 1-to-1 risk reward trades. So it's very, very important, I stress. It's all about process.
Awesome. We've had a question in the chats here. Since Fed is increasing rates, everyone was predicting recession, but the US economy is still strong compared to the UK, which has entered a technical recession. Do you think the USA will enter a recession this year, especially as this is an election year?
Yeah, I think the short answer is growth has been very much driven by fiscal dominance for most of last year. A lot of that fiscal dominance still exists this year. The US is still going to run a pretty large deficit. So does that mean the US economy goes into a recession? It's very, very unlikely. But keep in mind, fiscal dominance is very different to monetary policy. Okay, rates at 5.25% in the US is significant. It is quite significantly tight. It does matter for a lot of different asset classes, a lot of different industries, and that's what the Fed is really, really worried about. They're worried that yes, they've pushed rates up as quick as they've ever done in history, and they're just worried that perhaps it's too tight given inflation is kind of already back within where they want to see it. Okay, so I think sometimes, unfortunately, in social media, people say, oh, inflation came in at 3%, the Fed should still be hiking. It doesn't quite work that way because of the lag effect, right? A lot of the hiking that was done in 22 and 23, that's been around now for almost 18 months, and it is definitely causing a sort of reaction function in a lot of the markets. And there's a wonderful example if you go look back at 2008, where non-farm payrolls, if you look at some of the prints as we were already in the crisis, a lot of the prints came in really good. So non-farm payrolls was very positive. But in the subsequent months, when they had the revisions to the non-farm payrolls, they actually were, they were significantly downgraded to negative prints. Okay, so in other words, the economy can appear very strong still, but it's already in a recession. Okay, so most of the data we see is lagging, very much lagging, which is why the Fed is telling you, look, we'd rather cut sooner, we'd rather get ahead of this, because we think now this is as good as it gets, and things are only going to weaken if we don't begin the process of cutting. So hopefully that gives you an answer, a rounded answer.
This is a good question. I like this. You've suggested a daily loss limit. Is it also a good idea to have a daily profit target?
100%. Yes. Look, what I didn't mention, I'm always very aware of not giving rules of thumb, but we'll talk about this in series 2 in terms of what is a good baseline stop percentage of your account to have. Because a lot of traders say, well, how much should I risk? The short answer is it depends on your objectives. But in a summary, you can achieve almost any number of objectives if your percentage, your daily stop as a percentage of your account is between 2.5% to 5%. Okay, if you want to make bigger upside returns, you're going to need to risk more of your account. And if you're quite comfortable making 10-20% returns a year, you can risk quite a lot less of your account. Okay, so that's the first thing to stress. Now, in terms of targets, early in your career, 100% you got to have targets. Why? Because what you have to learn to do is bank money. What you have to learn to do is grow an account. And like I said, there's a direct correlation between a growing trade account and a growing position size, right? To make money as a trader is not about risk reward. It's about having bigger position sizes on your high probability trades. That is how you make money. If I'm using, I don't know, one lot in the S&P and I make, $100 on my trade, if I now have 5 lots on the S&P and I do the exact same trade, nothing changes, I make $500. So your objective is not to change the risk reward, not to change the process of how you trade, but it's to get your account balance growing so that as a direct result, your position size grows. And the only way you're going to grow an account balance is if you learn to bank money. Okay, so early in your career, I encourage traders always have at least a banking amount that's equal to your daily stop. Later on in your career, this becomes less important. Okay, but every now and again, for me, when I go on a bad run, I set in place a target. Why? Because my goal when I go on a bad run is just find green, find a little bit of consistency, find a bit of momentum, find a bit of confidence, and I'm going to get that by being green. Okay, so I still set targets, and this is year 13 of my trading career. So yes, targets are very important, and yeah.
You're asked, how should we trade news or data, especially non-farms, or should traders avoid it?
Okay, the short answer is I probably didn't give enough time to the event risks. Obviously, we were pushed a little bit for time. I will do this again in part 2. What we'll do is we'll cover CPI. So we'll cover US inflation because it's very market moving. It's very volatile for the markets. The short answer is how you have to see trading is volatility means opportunity. Okay, the more volatile the markets are, the more participants that are being dragged and forced into trading, and that means you've got to become quite active. When markets are not volatile and prices not moving around, that's when you've got to just safeguard your capital. That's when you have to kind of be a little bit more, sort of downsize, really pick your fights ultimately. Okay, so volatility by definition is very much what we want as traders. Now, how you trade non-farms is not, oh, I'm going to trade it, I'm going to get stuck in just because Brannigan said it's non-farms and it's volatile and I must trade. How you have to trade non-farms is you have to set up with what are the outliers. And what I mean by that is, if, for example, during non-farm payrolls tomorrow, the number comes out at 4.1%, I don't care how far up the page the 2-year US bonds blip. I'm not concerned about that, because if we have a 4.1% unemployment rate, what that means is that June is 100% going to be priced in as the starting point of a rate cut from the Fed. They're also likely to cut 4 times this year rather than 3 times, because the Fed has told us that they have got a dual mandate and they will focus on the employment side of things as well. So what that means is, because of the number, the market needs to reprice. And when there's a repricing event, there's less sensitivity to price. Okay, and that's key, because repricing events means you can pretty much trade any price and you should be profitable. In other words, the odds of there being a price directional move increases tremendously. Hopefully that answers your question. So it's not about avoiding volatility. It's about setting up correctly for volatility. And you do that by planning and prepping the outliers. But I will cover the CPI in part 2 of this series for you.
Okay, good stuff. Do you have any views on the gold-silver ratio?
Again, not something that, look, I've seen that ratio play out a lot. I know why people look at the ratio. It's not something I use. I prefer to use the gold copper, simply because that shows a little bit of more of a growth dynamic. That ratio sort of leans more on global growth. Silver, again, I understand why people lean on it. I think perhaps it gets pushed a little bit more because people don't feel comfortable buying gold at these record high levels. They feel, well, gold should be dragging silver up, so I'm going to go and buy the silver because it should follow gold. So again, they're two different markets. I think silver's a lot more of an industrial market. So I don't think that ratio matters as much today as it did perhaps 10, 15 years ago.
Okay. Oh, that's awesome stuff. Well, thanks very much, Brannigan, and thank you to everyone who's kind of posted questions and for attending the webinar today. If you do only kind of follow-up questions, then please contact us at hello@apmcapital.ae, and we can forward those, and Brannigan will be happy to answer. Please join us for the next webinar, which will be in the second week of May, and I'd just like to hand over to Nick for some parting words.
Well, I'll keep it very short and brief now, as we're near the end of the time Limited. Brannigan, thank you so much. It's really informative. I was really looking forward to this one, and I'm thoroughly looking forward to the next two parts in the series in the coming weeks. And also, once again, big thank you to the CME group who have helped us arrange this and are the event partner, and actually for introducing us to Brannigan as well. So thank you so much, and we'll see everybody in 2 weeks' time. And for those of you, enjoy a very enjoyable Eid as well, which is coming up next week for us.